There is a number that decides whether you can stop working, and it is almost certainly not the number printed on the front of your statement. It is not $1,460,000, which is what Americans told Northwestern Mutual in 2025 they believe they need to retire comfortably. The number that actually decides it is the distance between what you spend in a year and what Social Security and any pension will pay you in a year. That distance, not your balance, is the entire question. And most people never calculate it, which means a meaningful share of Americans over 50 are working extra years they do not need to work, not because the arithmetic says so, but because nobody ever ran the arithmetic for them. Here is the number nobody put on the chart: your annual spending gap. About 11 minutes with a bank statement, and it can move your retirement date by 3 to 5 years in either direction. I'm Pierce. 25 years as an accountant. Corporate tax, small business books, individual returns, audit prep. 25 years of sitting on the inside of other people's financial lives. And the most common sentence I've heard in the last decade of that work, usually from someone in their late 50s or early 60s, is some version of, "I know I am behind, I just need a few more years." Sometimes they are behind. Frequently, they are not. And more than once I have run the numbers for someone who had already crossed the line 2 or 3 years earlier and had spent that entire stretch working out of fear built on a benchmark that was never designed for their situation. Let me validate the fear before I take it apart, because the fear is rational given what people have been handed. According to the Federal Reserve Survey of Consumer Finances, the median retirement savings for Americans aged 55 to 64 is $185,000. For those aged 65 to 74, it is $200,000. Set those beside a headline number of $1,460,000, and the gap looks like a canyon. A 2025 survey from the Employee Benefit Research Institute found that only 28% of American workers are very confident they will be able to retire comfortably. 72% are carrying some level of doubt. That doubt is not irrational. It is the predictable result of measuring yourself against a target that was built in the wrong units. The real problem is not what you think it is. It is not that you saved too little. It is that the number you have been measuring against was constructed from your income, and you have never once in your life lived on your income. Look at where these targets come from. The most widely circulated benchmark in American retirement planning is the age-based multiplier that financial professionals at Fidelity publish. 1 times your annual income saved by age 30, 3 times by 40, 6 times by 50, 8 times by 60, 10 times by age 67. It is a reasonable rule of thumb. It is also an income replacement rule, built on the assumption that you will need to reproduce roughly 80% of your gross paycheck for 30 years. And gross paycheck is a fiction that never touched your checking account. Run it. If you earn $100,000, you pay $7,650 in Social Security and Medicare payroll tax before anything else happens. Say you put $15,000 into your 401k. Say federal and state income tax take another $15,000. You never lived on $100,000. You lived on roughly $62,000. And the day you retire, the payroll tax disappears completely because it applies to wages and you no longer have wages. The retirement contribution disappears because you are no longer contributing, you are drawing. The commuting, the parking, the work clothes, the lunches out, the second vehicle for many households, all of that either shrinks or vanishes. For a large number of people, the mortgage has been retired too. So the standard target asks you to fund a lifestyle you have never actually had, at a price you have never actually paid. The Bureau of Labor Statistics tracks this directly in the Consumer Expenditure Survey. Average annual spending across all American households runs around $77,000. Households headed by someone aged 65 or older spend meaningfully less, in the neighborhood of $60,000 a year. That is not deprivation. That is what happens when the commute, the payroll tax, the savings rate, and frequently the mortgage all come off the books in the same 12 months. Research by David Blanchett, published while he was head of retirement research at Morningstar, found that real inflation, adjusted retirement spending, tends to decline by roughly 1% per year through the retirement period, tracing a shape he described as a spending smile. Higher in the early active years, sagging through the middle, rising again late from healthcare costs. The standard planning model assumes a flat line rising with inflation forever. The observed behavior of actual retirees does something else. Now the other side of the equation, and this is the side people underweight most severely, you are not funding your spending entirely from your portfolio. According to the Social Security Administration, the average retired worker benefit runs around $2,000 a month, roughly $24,000 a year. For a married couple where both spouses have a work history, combined household benefits in the range of $40,000 a year are common, and higher earners who delay to age 70 can land well above that. That is inflation-adjusted income, guaranteed by the federal government, paid every month until you die, with a survivor provision attached. If you had to purchase that income stream on the open market, the price tag would be enormous. Nobody puts it on the balance sheet because it does not have a statement, an account number, or a login. Picture a house under construction with scaffolding around it. For years, the scaffolding is the only thing you look at. The pipes going in, the wiring, the drywall, the crew showing up every morning. Your entire relationship with that building is the work still remaining. Then one week, the interior work quietly finishes. The house is done. It is warm. It is wired. It holds. But the scaffolding is still bolted to the outside, so from the street, it looks exactly like a construction site. And the crew keeps showing up because nobody has told them to stop, and you keep paying them because from where you stand, the building still looks unfinished. The only thing standing between you and moving in is that nobody walked inside and looked. That is the situation a large number of Americans over 50 are living in right now. The house is finished. The scaffolding is the mental model. I'm going to prove this with numbers. Take two people, both 59, both with $400,000 in retirement accounts, identical statements, identical anxiety. Dale earns $90,000 and spends $54,000 a year. His projected Social Security benefit at his full retirement age is $28,800. His annual gap is $25,200. Using the 4% guideline that came out of William Bengen's 1994 research and the Trinity study that followed it, covering a gap requires roughly 25 times that gap in invested assets. 25 times $25,200 is $630,000. Dale has $400,000. Dale has real work left to do, and knowing that is worth something to him, because now he knows the size of the job. Rebecca, same age, same $400,000 balance, earns $78,000 and spends $42,000 a year. Her mortgage has 3 years left. Her projected benefit is $26,400. Her gap is $15,600. 25 times $15,600 is $390,000. Rebecca crossed her line before she walked into the room. She did not know it. She had been comparing her $400,000 to $1,460,000 and concluding she was 73% short of being allowed to stop. She was not 73% short. She was already there, and every additional year she works is a choice she is now free to make deliberately, rather than one made for her by a number she borrowed from a magazine. And if Rebecca keeps working 3 more years while that $400,000 compounds at 7%, which I use because it sits at the conservative end of the long-run historical return of the broad American stock market before inflation, commonly cited in the 7 to 10% range, she is building surplus she may never spend. That is a fine outcome if she chose it. It is a painful one if she did not know she was choosing it. I want to plant something here that I will come back to. Several years ago, a woman I will call Patricia, 64, a hospital administrator, came in for what she thought would be a 2-year plan to get herself ready. We opened her statements and ran the same arithmetic I just walked you through, and about 40 minutes in, she stopped talking entirely. She sat in my office in complete silence for close to a minute, which is a long time when you are the person across the desk. She was not upset about money. I will tell you exactly what she said and exactly what the numbers were when we get to the end of this, but I will tell you the shape of it now. She had already been ready for quite a while, and every institution in her financial life had a reason not to be the one to tell her. So let us go through the 5 signs, counting backward from the least surprising to the one that does the most work. Sign number 5. You know what you actually spend in a year, to within a few $100s, without guessing. Not your income. Not what you think you spend. The real figure, pulled from 12 months of bank and card statements, totaled and divided. Almost nobody has this number. People over 50 face this in silence, quietly assuming their spending is some vague large amount, because the exercise feels tedious and slightly humiliating. It is neither. It is 11 minutes, and it is the single most valuable number in your entire financial life, because every other retirement calculation you will ever run is built on top of it. If you have it, you are already doing something the overwhelming majority of American households never do. Sign number 4, the guaranteed, inflation-adjusted income you will receive covers most or all of your essential expenses, and you know that ratio by heart. Essentials means the things that do not stop if the market falls 40%. Housing, utilities, food, insurance, medicine, transportation, property tax. For most American households, that figure lands somewhere between 55 and 70% of total spending. The rest is travel, gifts, restaurants, hobbies, the grandkids, all of which are real and all of which can flex in a bad year without anyone losing a house. Now set your Social Security benefit beside that essentials figure. The Social Security Administration publishes your projected benefit at 3 ages on your annual statement, which you can pull in about 4 minutes at their website. Claiming at 62 cuts your benefit by roughly 30% against your full retirement age. Waiting past full retirement age adds delayed retirement credits of about 8% per year until 70, which produces a benefit roughly 24% higher than the full retirement age figure. Those percentages are not market projections, they are statutory. They are written into federal law and they arrive whether the market cooperates or not. Here is the piece that reframes the whole exercise. If your essentials run $34,000 a year and your household Social Security benefit is $38,000 a year, your portfolio is not responsible for keeping you alive. Your portfolio is responsible for the trips, the projects, and the cushion. That is a completely different job with a completely different risk profile, and the person whose essentials are covered by guaranteed income can survive a bad decade in the stock market in a way that the person drawing every dollar of their groceries from a brokerage account simply cannot. When people say they are afraid to retire, what they usually mean is that they are afraid of running out. Coverage of the essential floor by government guaranteed income is the specific structural condition that makes running out very unlikely, and almost nobody measures themselves against it. Sign number 3. Your invested assets are at or above 25 times your annual gap. We built the gap in the first part of this. Annual spending minus guaranteed income. 25 times that figure comes out of the withdrawal research that William Bengen published in 1994 and the Trinity study that followed, which tested 30-year retirement periods against actual historical market returns and found that an initial withdrawal rate around 4%, adjusted upward for inflation each year, survived the overwhelming majority of historical 30-year windows, including retirements that started immediately before 1929, 1973, and 2000. 25 times your gap is simply the inverse of 4% expressed as a balance. So a gap of $20,000 needs $500,000. A gap of $12,000 needs $300,000. Notice what has happened to the conversation. We started with $1,460,000 as the national anxiety number, and we have arrived at figures that a substantial number of American households over 50 have already reached without knowing it. The number did not change because I made an optimistic assumption. It changed because we stopped measuring against a stranger's income and started measuring against your own spending. This is the moment I have to say the thing that took me years to say out loud to clients, because it sounds like I am letting people off the hook, and I am not. This is not a discipline problem, it is a math problem. You did not fail to save enough. You were handed a target expressed in the wrong unit and then judged against it every year for 3 decades. Your behavior is correct. The system is not. The saving, the automating, the not panicking in 2008, the raise you routed into the 401k instead of the new car, all of that was right. What was missing was never willpower. What was missing was one subtraction problem that nobody in the entire chain of institutions surrounding your money had a reason to hand you. And that brings me to why nobody handed it to you. Because this part is not an accident, and it is not a conspiracy either. It is an incentive structure operating exactly as designed. Think about who touches your retirement money and how each one gets paid. The employer plan administrator is compensated based on plan assets. The mutual fund company is compensated as a percentage of assets under management. A great many financial advisors are compensated as a percentage of assets under management, commonly around 1% per year. Now ask a simple question. What is the financial consequence to each of those parties of you deciding you have enough and beginning to draw the account down? Their revenue falls, every single one of them. I am not saying anyone is lying to you. I am saying that in 25 years of reading these documents, I have never once seen a plan enrollment package, a quarterly statement, or a fund prospectus that contained the sentence, based on your spending, you may already have enough. Not once. The message is always accumulate more, contribute more, you are behind. The number is bigger than you think. The financial services industry knew this and said nothing, because the entire apparatus is built to move money in one direction, and there is no fee attached to telling someone they can stop. Look at what the same industry publishes about its own performance, and then look at what it charges. The SPIVA scorecard, produced by S&P Dow Jones Indices, is the standard measurement of active fund performance against benchmarks, and it is published by the same organization that builds the indexes. Over the 15-year period ending December of 2024, not one single United States equity fund category, 0 out of 22 categories, had a majority of active managers beating their benchmark. That result holds after accounting for funds that merged or shut down during the period, which matters enormously because dead funds quietly vanish from the marketing brochures. Over the 20-year period from 2005 through 2024, 94.1% of all domestic funds underperformed the S&P 1500 Composite Index. I read prospectuses. That is the job. And the fee disclosure language in most of these documents is written to be technically accurate and practically unreadable by a normal human being. A fund charging 1% per year on a $600,000 balance takes $6,000 out of that account annually. And it takes it whether the fund beats its benchmark or trails it by 4 percentage points. On a broad market index fund charging around 0.03%, the same balance costs about $180 a year. The gap between those two numbers, compounded across the decade you spend deciding whether you are allowed to retire, runs well into 6 figures. The window between when something is visible to those paying attention and when it becomes obvious to everyone is where generational wealth is built or lost, and fund costs have been visible in plain type for 40 years. Now let me close the loop on Patricia because I owe you the numbers. 64 years old, hospital administrator, 31 years in the same system. She came in expecting me to build her a 2-year runway to retirement. She had $610,000 in her 403B plan, a small legacy pension of $400 a month, and a paid-off house with $2,900 a year in property tax. Her fear number, the one she had carried for years, was $1 million. She had read it somewhere around 2014, and it had lived in her chest ever since. We pulled 12 months of statements and totaled her actual spending. $48,000 a year, and $11,000 of that was going straight into savings and her 403B, which meant her true consumption was closer to $37,000. Her Social Security statement projected $31,200 a year at her full retirement age of 66 and 8 months. Add the pension, and she had $36,000 of guaranteed, inflation-adjusted income against $37,000 of actual spending. Her gap was about $1,000 a year. 1,000. 25 times. That is $25,000. She had $610,000. That is when she stopped talking. She sat there and did not say anything for what felt like a very long time. And then she said quietly, "I could have stopped 3 years ago." She had turned down a part-time transition offer at 61. She had skipped a trip to see her daughter in Oregon 2 winters running because it felt irresponsible. And here was the part that made it worse. Her 403B lineup had been sitting in actively managed funds with an average expense ratio just over 1% for the entire time she held it. She had paid the industry roughly $6,000 a year to be told, implicitly, every quarter, that she was not there yet. She did not cry because she was poor. She had $610,000 and a paid-off house. She cried because 3 years of her life had been spent buying a certainty that the arithmetic could have given her for free. That is why I make these. Not because Patricia was ruined, but because she was fine and did not know it. And being fine and not knowing it has a price that does not show up on any statement. People over 50 carry this in silence, and the silence is the most expensive part. Sign number 2. And this is the one that separates people who are ready on paper from people who are ready in practice. You have solved the healthcare bridge, or you have honestly priced it. If you retire before 65, Medicare is not available to you yet, and health coverage becomes a line item that most planning tools handle badly. Under the Affordable Care Act marketplace, premium tax credits are calculated from your modified adjusted gross income, which in early retirement is largely a number you control because you choose which accounts to draw from. Withdrawals from a Roth individual retirement account do not count toward that income figure. Withdrawals from a traditional 401k do. That single distinction can swing a household's annual health insurance cost by many thousands of dollars per year during the bridge years, and it is invisible to anyone who has never had to build the projection. The second half of sign number 2 is the buffer, and this is where sequence of returns risk lives. During your working years, a market drop is a discount. You are buying every 2 weeks, so lower prices hand you more shares. The day you flip from depositing to withdrawing, that arithmetic inverts completely. If the market falls 30% in your first 2 years and you are selling shares every month to eat, those shares are gone. They do not participate in the recovery. 2 retirees can experience the exact same average annual return over 20 years and end in completely different places, purely because of the order the returns arrived in. The one who took the drop first can run out. The one who took it last is fine. The fix is not complicated, and it does not require predicting anything. You hold 2 to 3 years of your gap, not your total spending, your gap, in cash or short-term treasury instruments. If your gap is $18,000 a year, that is $36,000 to $54,000 parked outside the market. In a bad year, you spend from the buffer, and you leave the invested account alone to recover. As of early 2026, competitive high-yield savings accounts and short treasury instruments are paying somewhere around 4%, which means the buffer is not dead weight. But keep the buffer sized to the job. Safety that does not beat inflation is not safety. It is slow wealth destruction. And a retiree sitting in 90% cash for a 30-year retirement is guaranteeing a loss of purchasing power to avoid the possibility of a temporary paper one. Sign number 1, the last one, and the one that tells you the machine no longer needs you. Your portfolio's own expected growth in a year is larger than what you would add to it in a year by working. Run it. If you have $500,000 invested and you use 7%, which sits at the conservative end of the long-run historical return of the broad American stock market before inflation, generally cited in the 7 to 10% range, that account is expected to produce $35,000 of growth in a year. The maximum an employee can contribute to a 401k in 2026 is $24,500 per the Internal Revenue Service. If you are 50 or older, the limit is $32,500, and if you happen to be between 60 and 63, the super catch-up provision from the Secure 2.0 legislation allows up to $35,750. Even at the absolute legal ceiling, an account that size is doing more work than you are. That is the number that changes everything, because it means your additional working years are no longer building the retirement. They are adding a rounding error to something that is already compounding on its own. And people over 50 face this in silence, adding maximum contributions year after year to accounts that stopped needing them, because the statement never says, "You are now the smaller contributor here." 3 actions this week, and none of them require any money you do not already have. Action 1. 12 months of statements. One total, 11 minutes. Download the last full year of checking and credit card activity. Total the outflows. Subtract anything that was itself savings or investment, and write the number down. That is your true annual spending. Action 2. 4 minutes at the Social Security Administration website. Create the account, pull your statement, and write down your projected benefit at 62, at your full retirement age, and at 70. Add any pension. Subtract that total from your Action 1 number. What remains is your gap, and multiplying it by 25 gives you your actual target, not the borrowed one. Action 3. Check what you are paying to hold your investments. Pull each fund in your 401k or 403b and find the expense ratio. The Vanguard Total Stock Market Index Fund currently charges around 0.03%, roughly $30 a year, on a $100,000 position. If anything you hold charges above 0.5%, compare it directly to the lowest cost broad index option inside your own plan, because almost every plan has one now. On a $600,000 balance, moving from 1% to 0.03% keeps about $5,800 a year inside your account instead of outside it. And if you are still working and still contributing, the Roth Individual Retirement Account limit for 2026 is $7,500 or $8,600 if you are 50 or older, with the income phase-out running from $153,000 to $168,000 for single filers and $242,000 to $252,000 for married couples filing jointly. Roth dollars are the ones that do not count toward the income calculation that sets your health insurance subsidy before Medicare, which makes them unusually valuable to anyone planning to leave work before 65. Now think about what separates the person who runs this from the person who does not. Using Patricia's own numbers, she had $610,000 against a required $25,000. Suppose she had run the arithmetic at 61 instead of 64. 3 years earlier, she takes the part-time transition, cuts to 2 days a week, keeps her health coverage, and stops adding to the 403b entirely. Her balance still compounds. At 7%, $610,000 becomes roughly $747,000 over those same 3 years, without a single additional contribution. She takes the trip to Oregon twice. She does not lose ground. The account did not need her paycheck. It needed time, and time was the one resource she was spending to buy certainty she already had. Certainty never arrives before the price does. That is the whole trap. People wait for a feeling of being ready, and the feeling is manufactured by an industry with no incentive to produce it, so it never comes, and the price of waiting is paid in years that do not compound and do not come back. Here is what 1 more year of not running these numbers costs in plain dollars. Say you are 58 with $400,000 invested, and you spend the next year working purely out of uncertainty rather than choice. The account at 7% grows by $28,000, whether you show up to that job or not. What that year actually purchased you is 1 year of your life, at the specific age when your health and energy are more reliable than they will be at 72. Now run the other direction. If you discover you have a real gap and you spend 1 more year not closing it, $10,000 redirected today at 7% becomes about $19,600 in 10 years. Waiting 1 year to start makes it about $18,300. The delay costs roughly $1,300 per 10,000 permanently, and it costs it whether you are behind or ahead. The subtraction problem is the same 11 minutes either way. It just tells you a different thing to do afterward. So here is the protocol. I call it the FIT method. 3 components, and you can finish all 3 before Sunday. F is for floor. 11 minutes, 12 months of statements. Total, your real annual spending. and then split it into essential and discretionary. Essential is what continues in a terrible year. Write both numbers on the same page. I is for income. 4 minutes on the Social Security Administration website, plus whatever pension paperwork you have in a drawer. Write down your guaranteed annual income at each of the 3 claiming ages, then perform the 1 subtraction. Annual spending minus guaranteed income equals your gap. T is for test. Multiply the gap by 25. That is your target balance. Compare it to what you have. Then apply 2 tests to the result. Does your guaranteed income cover the essential floor from component F? And do you hold 2 to 3 years of gap spending in cash outside the market? Floor, income, test. 3 numbers, roughly 20 minutes, and it replaces every borrowed benchmark you have ever measured yourself against. The one mistake that invalidates the entire FIT method, and I see it constantly, is counting your own savings as spending. When people total up 12 months of outflows, they include the 401k contribution, the automatic transfer to the brokerage, the emergency fund deposit. Say that is $18,000 a year. That inflates your spending number by 18,000, which inflates your gap by 18,000, which multiplied by 25 inflates your target by $450,000. $450,000 of phantom requirement, created by counting the money you saved as money you spent. And notice where that error comes from. It comes from the same place the original problem came from, measuring in units of income instead of units of consumption. The invisible villain in this entire video is a benchmark built on your gross paycheck, and it sneaks back in at the exact moment you try to escape it. Strip the savings out. You will not spend your savings rate in retirement because in retirement there is nothing left to save for. If you are going to run the FIT method on your own accounts this week, meaning you are actually pulling the 12 months of statements and doing the subtraction and not just nodding along, comment floor below so I can see who is doing the work. And subscribe, because that is what lets this channel keep producing this kind of analysis instead of the version that just tells you to save more. Next week, I am going into the layer directly underneath this one. Once you know you have enough, which account do you draw from first, and why the order you withdraw in can change your lifetime tax bill by 6 figures without changing a single investment you own. One last thing, and I mean it. This is educational content built on publicly available data from the Federal Reserve, the Internal Revenue Service, the Social Security Administration, the Bureau of Labor Statistics, and S&P Dow Jones indices. It is not personalized financial advice, and nothing here accounts for the specifics of your situation. Every financial life is different, and the interactions between taxes, health coverage, claiming ages, and state rules are genuinely complicated. Before you make investment, tax, or retirement decisions, sit down with a licensed professional who can review your actual circumstances.